Responsibility accounting. Responsibility accounting is a system of control where responsibility is assigned for the control of costs. The persons are made responsible for the control of costs. Proper authority is given to the persons so that they are able to keep up their performance. Responsibility accounting is a system of accounting that recognizes various responsibility centers throughout the organization and reflects the plans and actions of each of these centers by assigning particular revenues and costs to the one having the pertinent responsibility. Responsibility accounting is an underlying concept of accounting performance measurement systems. The basic idea is that large diversified organizations are difficult, if not impossible, to manage as a single segment, thus they must be decentralized or separated into manageable parts. These parts, or segments, are referred to as responsibility centers that include 1. Revenue centers. 2. Cost centers. 3. Profit centers, and 4. Investment centers. This approach allows responsibility to be assigned to the segment managers that have the greatest amount of influence over the key elements to be managed. Controllability concept. An underlying concept of responsibility accounting is referred to as controllability. Conceptually, a manager should only be held responsible for those aspects of performance that he or she can control. There are usually 4 types of responsibility center which are identified as a cost center. Under the cost center, the manager is held responsible only for the costs, which generally include a production department, maintenance department, human resource department, etc. A profit centers. Under the profit center, the manager is responsible for all of the costs and the revenues. Here the manager would have all of the responsibility to make decisions that would affect both the cost as well as the revenue. A revenue center. This segment is primarily responsible for attaining sales revenue. The performance would be evaluated by comparing the actual revenue attained with that of the budgeted revenue. An investment center. This center, apart from having to look into the profits, looks into returns on the funds invested in the group's operations during its time. For a revenue center, a good example would be the sales department or the salesperson. For a cost, a good example, in this case, would be the janitor department. For a profit center, this would be a product line for which the product manager will be responsible. For an investment center, example would be that of a subsidiary entity for which the subsidiary's president is held responsible. This concludes a quick overview of responsibility accounting.